They are things that are going on in the process of silver going to a new reality. Gold's already, like I've said before, gold, each bull market well exceeds the prior high. Silver didn't, okay? And silver's changing that now. But gold's bull moves, for example, have been eightfold moves. Bear low to bull high, 1976 to 1980, eightfold, 8 times the bear low. 2001 low to 2011 high, much different span of time, but an eightfold move. Okay, if we have an eightfold move, in other words, if we just do it again, it's probably an expression of the tightness of what's going on, but it's just a reflection of the underlying silver crisis that we're facing in terms of supply demand and its essential nature. I think even Elon Musk the other day said something to that effect, that we got to have silver for AI and so forth, and it's essential in all these tech things and so forth. It used to be, silver primarily industrial use was in photographs. Snap a picture, the processing involved the silver in the film. Now it's solar panels, powered the solar panels, the AI, massive technology buildup and so forth, where silver is just everywhere in there, and maybe in microscopic levels, but nevertheless pervasive and essential. And yet we've had 5 years, I understand, of we don't focus on supply demand. I'm looking mainly at the technicals, although I am fully aware of larger fundamentals beyond just silver's industrial thing. But we've got 5 years of supply deficit to demand. And it's not getting better, despite the rising price. In most markets, if a commodity is too low to incentivize more of the commodity, you take the price up. And therefore, you produce more of it, more wheat, more sugar, whatever. In the case of silver, it's hard to do because most silver doesn't come from silver mines. It comes from base metal mining. And the primary incentive for those folks is the base metal price, not silver price, even though they get a marginal amount of silver, which is the majority of the supply comes that way. So it's kind of a unique fundamental and technical squeeze that's underway here. And that's why we claim it's going into a new reality. Don't think in terms of normality here. This is not going to be some normal bull trend. No, that level probably wouldn't. We think silver's going to hundreds, okay? And I can't pin it down, except to say that I know if you fundamentally go back and factor in the decay in the U.S. dollar buying power, in other words, the quantity of dollars that exist, which goes up like, 80, 90% every 10 years, the supply of dollars. I'm not talking dollar versus euro or yen or anything, but literally the buying power of the fiat unit. And if you factored in getting to a price that reflects 1980, for example, when it was 50, or 2011 when it was 50, you'd be in a couple $100 just to get back to that level in terms of real buying power. When a market makes mistakes, either overpricing or underpricing, and everybody's especially aware of overpricing because we've seen stock market bubbles. And whenever that occurs, too high for too long, when it snaps, it doesn't do it rationally. It quite often overshoots where it ought to be. So it goes too deep, or just like on the upside, it goes too high for too long and then snaps the other way. Silver's been caught in a box for 50 years. You can look at copper or lead, and we've run studies on this, where they were caught in a range for multiple decades, 1970s, 80s, 90s, 2000, and mid to late 2005, for example, copper had been in this old reality of price range. And it broke out, and literally in a couple of quarters, it quadrupled. And it wasn't in sync with other base metals. It was on its own, okay? Quadrupled in price literally in several quarters, going to a new reality, in other words. And then when it finally leveled off for the subsequent decades, past 20 years or so, it leveled off at a range that was like 4 times the average price of that prior range. But the process of getting from the old range to the new range was a thunderbolt. It wasn't, let's get up there slowly and methodological, in an incremental manner. It was literally ripped the page off. And it no doubt overdid itself in getting to the new reality and then pulled back into a new reality. Same occurred with lead in 2007. Very exciting metal, okay? Silver's been caught in this 50-year range. Gold hasn't been caught in a 50-year range. It has eightfold moves. It goes way above the prior 1980 high or the 2011 high, et cetera, et cetera. Silver been capped. What's going on there? You know, is it a dog? Is it really non-essential? You know, lead did it. Copper did it, and I could find a dozen other markets that have done something similar over the past 50 years or so. But silver was contained. Well, it's no longer contained, and therefore it's going to do something excessive on the upside, getting to a new level of price reality. And it's going to be fast. And we're in that process, and we're just in that process. Only in the past month have we entered that phase. So put your seatbelt on. And be ready for days like what we're seeing today. When you were interviewing me, silver had a drop from $82 down to 71. You know, and everything's, oh, it's the end of the world. No, it's, another 10% so drop in a heartbeat. And it doesn't interrupt the real process underneath that's going on.
For nearly 50 years, silver remained trapped in a tight trading range, while other metals broke out and redefined their value. Copper and lead each endured long periods of consolidation before erupting into explosive moves that permanently reset their price structures. Silver never made that leap. Until now, markets held down for decades rarely reprice in an orderly way. When suppression finally gives way, the release is usually violent and exaggerated. Silver's prolonged confinement has built enormous pressure, and the recent surge in price signals that the old ceiling has been decisively shattered. This isn't a conventional bull market marked by smooth, incremental gains. It's a regime shift, rapid, volatile, and emotionally demanding, as silver transitions from an obsolete pricing model into an entirely new reality.
We measure silver, we measure any market. We look at all kinds of asset categories, stock markets, bond markets, commodities in general, foreign exchange, especially the monetary metals, silver, gold, and miners, okay? What was going on back then was you're already in a bull market. I mean, silver was already advancing. When we put out a major buy signal in March of 2024, silver was about $25, $26. We said, okay, it's coming out of its sleep pattern. It's been in since 2020. And whoosh, you shot up to 35. And then you effectively spent a year in a range with two peaks at 35, October of 2024 and March of 25, in a like a $10 range. And then when you came back up toward the top of that range, in, like you said, in June, July of this year, we said, that's it, you're coming out of here. This time is the acceleration phase. No longer, let's gain $5 and halt and $5, et cetera. And so we whooshed up into the over 50, okay. Fought there a little bit, and then next thing you know, we traded 82, okay. All right. That was a technical signal we got from the momentum of the price action. In other words, just looking at price and its momentum. And we measure momentum differently than most people do. Anyway, and that told us, okay, this time silver is going to accelerate more than you've expected to see. This time, what happened that caused us to say new reality commencing is the spread relationship between silver and gold. The mama metal, gold, and the lesser child of the monetary metal, silver. And as we just talked about, gold keeps making higher highs over the decades, and silver's caught in a box. Well, the spread relationship, when we plot an ounce of silver to an ounce of gold and express it as a percent, we plot that, okay, and we analyze that technically. The close of November, we had a spread breakout, meaning while silver's been underperforming gold since that 2020 surge in silver, remember when the post-COVID thing, silver exploded, doubled, and gold went up 40%. Silver outperformed them, but in the years that followed, it eroded back down in relative performance, meaning it was going up with gold, but at a lesser pace. But that ended at the November close. And November, we closed in the mid-50s. Okay, here we are a month later with a couple days left, and we're in the 70s. Wow. $20 in a month, that's pretty cool. Well, what warned of that wasn't that silver's in an uptrend. It's been an uptrend for a couple years. No big deal. It's the spread breakout when silver broke out relative to gold. The same thing happened back in 1979 during that rush in silver. It went from like the teens to $50 in 5 or 6 months. Okay. It's when the spread broke out, silver favoring over gold, that suddenly silver went rampant. And it both went up, but silver just left the page. Okay. Same thing happened in 2010 during that already aged bull market in silver, been going up for years. There was a point at which its spread broke out versus gold, and in the next 7 months, silver doubled in a half. Boom, doubled in a half. Very quickly. We argued when the spread broke out this time in November that process is now commencing here for silver. And if you go back and look at that copper I talked about, or the lead charts even, when you entered that new search for a new reality, you did it so quickly. It was always a couple quarters. It's very amazing. And the same with 79 to 80. It was a couple quarters, like 5, 6 months. In the case of 10 to 11, it was 7 months from the spread breakout to the peak of silver at 50. I expect in the next 6 months, and this is month 1 in the countdown. We're already closing November. We started, so December's month 1. But in the next couple quarters after that November close, I think you'll see silver with sharp sell-offs in the process reach at least 200 and possibly a lot higher in a rampage. Yeah, there'll be a correction in the middle somewhere, probably. There was in 1979, there was a little correction in the middle that fooled people. Same in 2010 to 11, there was a reversal month. There was a fake out, and you exploded more. So sometime, let's say mid to late first quarter, you might get a correction that you could really call a correction. Not what we're seeing today. This is just a quick jerk, okay? But sit back and give it a couple quarters. And I think you'll see that it doesn't just get to what you could call a fair value based on the degradation in the money unit, meaning $200 an ounce or so, but probably overshoot it vastly. And plus, there's the other factor that we haven't talked about, and it's not just that silver's an key industrial metal; it's a monetary metal. And when certain other events outside of the monetary metals occur, like we have an underlying earthquake-type crisis building in some major government bonds, our bonds, Japanese bonds, UK, etc. There's a lot of big bond markets where there's underlying crisis already there, just hasn't ripped open and exposed itself fully. And when that does, that'll create huge waves of doubt and panic and impacts on other markets like the stock market, down, etc. So all these factors can come into play, in which case the central banks go ape, absolutely crazy, trying to save their government bond markets, and therefore printing money, which is the lifeblood of what gold is. Gold is money. You destroy your paper, gold goes up, etc. So I think that's the real underlying major factor in play here, not just the silver supply demand.
The most telling warning didn't come from silver in isolation, but from its relationship with gold. Historically, when silver begins to outperform gold, explosive moves tend to follow. That relative breakout has preceded major surges before, most notably in 1979 and again in 2010. Recently, the same shift has reappeared. Silver stopped lagging and started leading. Within weeks, prices surged sharply. This matters because silver is the more volatile monetary metal. When confidence erodes and momentum flips, silver doesn't inch higher. It accelerates. This breakout signals more than strength. It signals urgency. It suggests markets are repricing risk far faster than the headlines would have you believe.
Yeah, I think so, and you'll see it here and then there. What's going to cause it to be more widespread? The monetization of monetary metals again. The recognition that, gosh, this past very long human lifetime, we have just printed 100 years or so. We've had a central bank here for 110 years that prints and prints in cycles. And it's true in Japan, it's true in Europe, etc. So, and it hasn't worked. And you've got to create, though, probably panic And you'll never see panic on the face of a Fed governor. Okay, they're always, everything's under control. But I'm talking about the average guy. Because if you impact that stock market in this process, and I think the stock market has been topping since January, it's a laborious, marginally new highs, etc. It's the same thing it did in 2000, same thing it did in 2007, where you make a high, pull back, and make another new high, and everybody thinks, oh, it's going to go forever. But when that beast rolls over, and I think that's probably you're going to start to see evidence of that the average guy can realize late in the first quarter, and especially into the second quarter of next year, where, because it's the only thing people could smile about. Their retirement account. Hey, S&P's up 10, 15%. Oh boy. Meanwhile, gold's up, 100% or whatever, but they ignore that. But if you take that away from them, the average guy who's not really feeling that good about other aspects, financial aspects of his life, then suddenly there's doubt, there's fear. And you inject emotion into it, and that's when you get political ramifications and therefore pressures, even among academicians, to say, yeah, this central bank thing hasn't really been working well. It's just been a matter of constant boom-bust cycles, monetary booms, stock market booms thereafter, et cetera, et cetera. And that's when you get the doubt and hence those kind of changes you mentioned. Right now it's just here and there, but it could be far more widespread when these other events unfold. And I think gold and silver know that's underway. The smart money buying it knows something's wrong out there. I want to own real money. And that's what's really the underlying power of these moves.
Silver's move isn't just an industrial story. It's a monetary one. Cracks are spreading through global debt markets, especially in government bonds that were once considered untouchable. Bonds no longer offer protection when stocks stumble, shattering portfolio assumptions that have held for decades. Central banks now face a familiar trap: stabilize markets or defend the currency. Rarely can they do both. History suggests the usual response is liquidity, more money creation. Gold reacts first. Silver follows, often with greater force. As confidence in paper systems fades, investors gravitate toward tangible assets. That shift doesn't require panic from policymakers. Only a slow, growing unease among everyday savers as they watch their purchasing power steadily erode.
It's a factor out there, and it's indicative of what's going on in terms of one side being pressured or another, and these things off to the side that we like to cite. Like, did this bank intervene to suppress silver? Or they got caught and they're getting hurt or whatever. These things are going on the side all the time, and you'll probably hear more of them, but they're not really the driving force. They are things that are going on in the process of silver going to a new reality. Gold's already, like I've said before, gold, each bull market well exceeds the prior high. Silver didn't, okay? And silver's changing that now. But gold's bull moves, for example, have been eightfold moves. Bear low to bull high, 1976 to 1980, eightfold, 8 times the bear low. 2001 low to 2011 high, much different span of time, but an eightfold move. Okay, if we have an eightfold move, in other words, if we just do it again, have another routine eightfold move, would be $8,500 because our bear low was $1,050, okay, in 2015. So that's just getting back to normal in terms of having matched a prior bull market in terms of dimensionality. There's even bigger stuff going on this time than it was in 1980 or 2011. So we don't, I think 8,000 is just sort of, I throw the number out, not as a prediction, just saying, if it goes there, it's done it again, But we've got underlying stuff that we've not had before. In 2007, we had a mortgage crisis, meaning, mom and pop mortgages failed. Okay, not government bonds. All of a sudden now we got government bonds in trouble. And the Fed can cut rates all they want on the short end. It doesn't help the T-bonds. And the governor of the president of the New York Fed, I forget his name, Williams, I'm not sure, about a month ago made a statement, either a press conference or a speech, but I'm sure it was permitted to be said, that the Fed is going to start buying, quote, buying bonds to help liquidity, was his excuse. Oh, not that there's a problem there. It's just the liquidity issue. Right, that's great. And he smiled. That's a statement that they're going to print money to save, the U.S. government debt market if they can. And if you look at the T-bonds, they're not an alternative to the stock market anymore. The 60-40 principle of 60% stock. It just doesn't work. In fact, one of the major banks came out with a statement a couple of months ago, said, no, it should be 60-20-20. Gold being, it more likely should be 60% gold, 20-20. But anyway, the point is there's a recognition that something's wrong with that alternative. And if you look at a T-bond chart, it's comatose. You can even have a bad week or so in the stock market, and it just sits there. It's not an alternative. And if it flinches about 4 points below where it is right now, we're trading around 115 on the T-bond futures right now. You get down around 111, watch out, put your helmet on, because you could have a downside collapse that sparks the Federal Reserve into something drastic and sudden, hence fueling the monetary metals.